ये कानपुर में 30 साल से वही पढ़ा रहा है,
कोचिंग ले लिया आपने?
तो वो हमारा एक्सपर्टाइज है।
अच्छा,
तो अगर जरूरत हो कभी तो हमारे पास ही हो आप तो।
ठीक सर, ठीक है।
मतलब कभी नहीं, एनी टाइम। बस एक फ़ोन की ज़रूरत है, बाकी और कोई ज़रूरत नहीं है। फ़ोन किस लिए? क्योंकि पता नहीं आए तो मिले ही नहीं।
ठीक सर, ठीक। टेम्परेरी बेसिस पे है ना सर बिल्डिंग, इसलिए कुछ काम हो भी नहीं रहा यहाँ पर। जैसे कुछ चीज़ खराब है ना, वो फिर कह रहे हैं कि नहीं तो अभी थोड़े दिन की बात है, मैं शिफ्ट हो रहा हूँ।
कब तक उम्मीद है शिफ्ट होने की?
वो सब तैयार हो गई है सर, बिल्डिंग तो सब कुछ तैयार होगा। एक तो कुछ एनओसीज वगैरह रखी हुई है जो लेनी पड़ती है, आपको पता ही है, और कुछ सरकार जो इनोवेशन करेगी ना सर, मिनिस्टर करेगा, बस वहाँ बात रुकी हुई है।
चक्कर में कि नरेंद्र मोदी मिल जाएंगे।
क्या वो तो नहीं कर पाएंगे, वो तो नरेंद्र मोदी जी तो ये छोटी मोटी चीज के लिए तो नहीं आएंगे, उनके लिए तो बहुत छोटी चीज है।
उनके मन की बात है। तो ट्रेन को भी छुट्टी दिखा रहे थे।
वो तो सर प्रमोशन है बस एक।
उनके मन की बात है, उनको अगर समझ में आ जाए तो सब चीज ठीक है। म्यूनिसिपल एजुकेशन
उसके लिए सर मैं आता हूँ आपके बनाया ना, फिर कुछ दिन लगना पड़ेगा तैयारी में।
Good morning. The counseling session is MMPF to financial decisions. Nature of long-term financial decision. Financial decision refer to decisions concerning financial matters of a business. A few specific points in this regard are: financial decisions are taken by a finance manager alone or in conjunction with other management colleagues of the enterprise. They may be from the purchase department, sales department, personnel, etc., etc. And they may be from the finance department itself. A finance manager is responsible to handle all such problems as involve financial matters. The entire gamut of financial decisions can be classified in three broad categories: investment decisions, financial decisions, and dividend policy decisions. You may say that this is the subject matter of this course. We have to study these decisions: investment, financial, and dividend policy decisions. Today we are discussing a short reference to the subject matter: investment decisions. The most important financial decision is concerned with determining the total amount of assets to be held in the firm, the makeup of these assets, and the business risk complexion of the firm as perceived by the investors. The salient features of investment decisions are as follows. The investment decisions are of two types, namely long-term investment decisions and short-term investment decisions. Long-term investment decision decides about the allocation of capital to investment projects whose benefits accrue for long period. It is concerned with deciding what capital expenditure should the firm make, what volume of funds should be committed, how should funds be allocated as among different investment opportunities. We will study this in the next counseling session in detail. Short-term investment decision decides about allocation of funds as among cash and equivalents, receivables, and inventories. A firm may have a number of profitable investment proposals. However, owing to paucity of funds, managers should be meticulous in choosing the most profitable one. Thrust of financial decisions is on building suitable assets mix. Financing decision. In financing decision, finance manager has to decide about the optimal financing mix. Highlights of financing decisions are as follows. Question of making financial decision arise as soon as the decision regarding investment outlets is made. At times, investment decision follows financing decision. Means sometimes first investment decision is made, then financing decision arises, and sometimes first financing decision is made and then investment decision arises. A finance manager has to decide the appropriate mix of debt and equity in such a way that wealth of the shareholder is maximized. The main purpose of any business is the maximization of wealth. This is the ultimate objective. And the finance minister has to decide in such a way that the wealth of shareholders is maximized. The financing will be either from debt or from equity. What should be the appropriate mix It is to be decided by the finance manager. A finance manager is supposed to delve into the following issues requiring financial decisions. From which sources are funds available? Mainly debt and equity. Debt also from different sources, maybe from banks, maybe from debentures, maybe from financial institutions, etc. etc. To what extent are funds available from these sources? From every source, how much funds are available? What is the cost of funds presently used? And also, next, what is the expected cost of financing? From different sources, what is the cost of funding? And what instruments should be employed to raise funds and at what time? Should firm approach financial institutions for securing funds? What will be the terms and conditions on which the funds will be raised from different sources? What will be the nature of underwriting arrangements? Underwriting, the underwriter takes the responsibility that the shares or debentures will be in one term will be sold or will be subscribed to the full. Otherwise, the underwriter will take the responsibility and will make the payment and will himself subscribe to the shares or debentures. What innovations can be made in raising funds? From wide variety of sources. A finance manager has to be in constant touch with financial markets. Financing decisions are primarily concerned with capital structure, equity capital, preference capital, or debt equity composition. What is the share of equity and what is the share of debt? The third decision is dividend policy decision. Dividend policy decision decides about allocation of business earnings between payment to shareholders and retained earnings. Whatever profit has been earned by the business unit, this may be either retained in the business itself, retained in the company itself, or may be distributed to shareholder. How much is to be distributed to shareholder and how much is to be retained? This is the scope of dividend policy decision. A few specific points in this regard are as follows. Number one, closely related to the issue of raising finance is the issue of distribution of profits. This constitutes the area of dividend decisions. Although both growth and dividends are desirable, these two goals are conflicting. A higher dividend rate means less retained earnings and consequently a slower rate of growth in earnings and stock prices. If the whole profit or the major part of profit is distributed as dividend, then there will be no amount or less amount for retained earnings. And retained earnings are used for the growth and increase in the stock prices. The finance manager has to decide the ideal ratio between the dividends, distribution of dividend, and retaining the earnings. For maximization the shareholders' wealth, the finance manager has to strike a satisfactory compromise between the two, a satisfactory ratio. A prudent finance manager takes dividend decision in the light of investors' preference, liquidity position of the firm, and stability of earnings of the firm. Need to repay debt, restrictions in debt contracts, and access to capital market, etc. Means what is the preference of investor? Whether investor wants immediate payout or dividend, or investors want increase in the value of share. Normally, investors want both. He should be paid dividend for current use as well as the prices of shares should increase. For payment of dividend, the financial manager has to see the liquidity position of the firm, whether sufficient cash we want to invest in a new business, new building, want to purchase new machinery. But if the finance is not available, the decision will be useless. And finance is available, but if proper investment decision is not made, then it will be a source of future loss, and that will be a bad decision. In fact, neither decision by itself makes sense without the other. There would be no financing decisions to make in the absence of investment decisions, and vice versa. Number two, investment decisions versus financing decision, fundamental difference. What is the fundamental difference between the two? Evidently, both financing as well as investment decisions involve a certain selection of cash flows. Typically, a financing decision involves accepting cash today, that is inflow from the capital market, and repaying the same together with interest or dividend. Interest in case of debt and dividend in case of equity, subsequently over a period of time, that is outflows. On the other hand, an investment decision involves investing the cash today in the product market, that is outflow, and receiving a stream of earnings inflows subsequently. Or you may say that there is inverse correlationship. Inflows of the finance will become outflow of the investment, and vice versa. Relationship through net present value. If after paying all lenders their interest and shareholders their normally expected dividend, some surplus is left, obviously it will belong to the shareholders, thereby increasing their wealth. Obtaining a positive net present value, we are discussing after some time, implies the same thing as minimizing the cost of capital. Wealth maximization and maximization of profit pool objectives. Wealth maximization objective has come to be widely recognized criteria with which the performance of a business enterprise is evaluated. The word wealth refers to the net present worth of the firm. Net present worth is the difference between gross present worth and the amount of capital investment required to achieve the benefits. Gross present worth represents the present value of expected cash flows, discounted at a rate which reflects their certainty or uncertainty. The wealth maximization objective has the advantage of exactness and unambiguity and takes care of time value and risk factor. Net present value, time value, we are discussing after some time. Value maximization is wealth maximization. Assuming the shareholders to be economically rational beings, they want to get as rich as possible through their stake in the business. As rich as possible, this relates to the present period as well as the future period. In other words, they want to maximize their wealth. That is market value of shareholding. The shareholders seek to maximize their return for a given level of risk or minimize their risk for a given level of return. Objective of maximization of profit pool. A profit pool can be defined as the total profits earned in an industry at all points along the industry's value chain. It includes disaggregation of processes, mapping of the value chain beyond the confines of legal entities, adoption of flexible organizational structures, and creation of network organizations. Main highlights of this objective are: profit pool concept is based on the concept of looking beyond the core business. Shape of a profit pool reflects the competitive dynamics of a business. Profit concentrations emanate from actions and interactions of companies and customers. A profit pool is not stagnant. A profit pool map answers the most pertinent question: where and how is money being made? Profit pool may prompt the management to examine how same profit sources exert influence over others and same shape competition. Net present value rule. Net present value is actually, in common sense, if we take the formula of compound interest, net present value is the principal of a particular amount in future. Wealth maximization gives net present value rule as the most basic rule of financial decision making. The concept of net present value is based on the formula of compound interest. The difference of the total present value of every cash received during the life of the investment and initial cash outflow is net present value. Suppose we invest rupees 100 and the interest rate is say 10%. After 1 year, this 100 will become rupees 110. After 2 years, 10% will be added to 110 and it will become 1 rupees 121. In other words, we may say rupees 100 after 1 year is rupees 100 today, or rupees 121 after 2 years is rupees 100 today. This is the time value of money. If we get more than something after, say, more than 110 after 1 year or more than 121 after 2 years, then it will be positive net present value. If we get less than that, then it will be a negative positive value. It should be clear that if the new present value of an investment were to be negative, the investor would be better off by investing their funds elsewhere. Thus, the manager must invest the shareholders' funds only in ventures which yield positive net present value, such that the value of their shares is maximized. Cardinal principles of financial decisions. A finance manager, in his attempt to maximize corporate value of the firm, must keep in view the following basic considerations while making financial decisions. First one is strategic principle. According to this principle, financial decision of a firm should be tethered to the overall corporate objectives and strategies. Financial decisions should not be against the corporate objective or strategies. For example, if the corporate objective is to gain maximum share in the market, then financial decision should be taken as per that decision, which increase the market shares in the business. Optimization principle. Thrust of financial decisions should be on intensive use of available funds. And for that purpose, proper balance between fixed and working capital should be sought. The ratio of fixed and working capital should be the ideal one, which help in attaining the corporate objectives and strategies. Risk return principle. Maintaining suitable balance between risk and return is the crux of financial decision making. If you take risk, higher the risk, there will be higher the return. But at the same time, there are chances that you may lose the money. What is the suitable balance? This is to be maintained. Marginal principle. According to this principle, a firm should continue to operate up to the point where its marginal revenue is just equal to its marginal cost. The marginal revenue, they have got a decreasing trend. In start, revenue has got an increasing trend, then it becomes constant, but in the end it has got a decreasing trend. While the marginal cost has got a reverse trend. In the start, it will decrease, then it will become constant, and in the long run, it will become increasing. In other words, in the long term, marginal revenue has got the decreasing graph and marginal cost has got the increasing graph. Where they meet, that is that point is the most reasonable, most operating point. Suitability principle. Focus of this principle is on creating an asset by a financial instrument of the same approximate maturity. Flexibility principle. According to this principle, financial plan of a firm should be capable to being changed in sync with changing environment. If in the market there is shortage of funds, then the company should have a plan where it need not to get the finance from the market. Timing principle. Timing should be crucial consideration in financial decisions. Investment and financing decisions should be taken at a time that enables the organization to seize market opportunities and minimize cost of raising funds. The finance, financial manager should have a long-term view. When will the market have opportunities, and he should be in a position to get the maximum benefit of those opportunities. And at the same time, he must also see that the cost of raising the funds is the minimum. Time value of money. Time value of money or time preference for money is one of the central ideas in finance. Money has a time value because of the following reasons. Individuals generally prefer current consumption. If anybody is asked that you may get rupees 100 today or rupees 100 after 1 year, he will prefer 100 today. An investor can profitably imply a rupee received today to give him a higher value to be received tomorrow. There are various modes available to any investor where he can invest money and he will get after some time a more amount. Future is uncertain. If the investor is getting the same what he is getting tomorrow, he will not invest. As we have just discussed, that rupees 100 after 2 years will become rupees 121. If the investor gets rupees 121 after 2 years, then he will not invest and he will prefer rupees 100 today. Inflationary pressures make the money received in future of lesser purchasing power. You might have heard that if you keep your money in your savings bank account, actually you are losing the money. In savings bank account, normally bank gives 2 to 3% per annum interest, while the inflation is somewhere 5 to 6%. Means we are losing money in the savings bank account. Thus, there is preference of having money at present than at a future point. This automatically means that a person will have to pay in future more for a rupee received today. A person may prefer to accept less today for a rupee to be received in future. We have already discussed that rupees 110 after 1 year in the example is equal to rupees 100 today, or rupees 121 after 2 years is equal to rupees 100 today. They are called compounded value and discounted value. 110 or 121 is the compounded value of rupees 100 today, and vice versa. Rupees 100 is the discounted value of rupees 110 or rupees 120. Determination of implied interest rates, implied principal amount, and annuities. Determination of implied interest rate. Implied interest rate is the rate at which the present value of the amount repaid will be equal to the amount borrowed. As we have taken the example, rupees 121 after 2 years, rupees 100 today, they are equal at the rate of 10%. Therefore, the implied interest rate is 10% for the amount borrowed rupees 100 and amount repaid rupees 121 after 2 years. Determination of the implied principal amount. Implied principal amount is the amount which is equal to the present value of the amount repaid at the required rate of interest. For example, in the same example, if the required rate of interest is 10%, then if the rupees 121 is paid after 2 years, then implied principal amount is rupees 100. Determination of annuities. Annuities are the installments, the total of whose present value is equal to the initial outlay. In example which we have taken, rupees 110 is after 1 year and rupees 121 is after 2 years. But if these amounts are same, say rupees 1000 every year is paid, say for 10 years. So for rupees 1000 paid after 1 year, what is the present value today? Rupees 1000 paid after 2 years, what is the present value today? And so on for every rupees 1000 paid from 3rd year to 10th year. And the total of these present values, if they are equal to the principal, then it is the annuity amount. Factors influencing long-term financing decisions. A finance manager has to exercise great skill and prudence while taking long-term financial decisions, since they affect the financial health of the enterprise over a long period of time. The factors affecting his decisions are: first, external factors, state of economy, that is phase of trade cycle. You know that in trade cycle there are sometimes boom, sometimes depression. In which state economy is there, whether it is in boom or it is in depression. Institutional structures of capital market, whether they are developed or undeveloped. State regulations in financing, if they are debt equity norms, dividend payment restrictions, etc. Taxation policy, expectations of investors in terms of safety, liquidity, and profitability. All the three at the same time. Investor wants basically safety of his money, wants liquidity also, Whenever he wants money, it should be available to him. And the investment must give some profit. Lending policies of financial institutions. Now, the internal factors, nature of business, in which business the unit is. The nature of business will affect the financing decisions. For example, if in a particular business the units are doing business on the capital amount, on the own investment, then you are not going to get debt from the market. Size of business. If the business is a large business, it will be the finance will be easily available to the business. In case of a small business, the finance is not so easily available. Age of the firm. And with the age of the firm, there also goes the goodwill of the firm. As the age of the firms increases, the goodwill also increases, unless otherwise the business is not managed properly. Ownership structure. How much ownership is from the financial institutions, from the promoters, and from the general public. Assets structure of the firm. Long-term assets and short-term assets. Liquidity position of the firm. Availability of cash. If there is surplus cash, the decision will be different from if there is paucity of funds. Expected return, cost, and risk. How much return is expected? What is the cost of investment? What are the risks involved? Probabilities of regular and steady earnings, and the attitude of management. Now the next part, cost of capital. The term cost of capital refers to the minimum rate of return that a firm must earn on its investment so as to keep the value of the enterprise intact. It represents the rate of return which the firm must pay to the suppliers of capital for use of their funds. The following are the basic characteristics of cost of capital. Cost of capital is really a rate of return. It is not a cost as such. Means normally the cost is related to the absolute amount. Here it is not. It is the rate of return. Means if the bank has given you a loan of rupees say 10 lakh at 12% rate of 12% per annum rate of interest, then cost of capital is 12%. A firm's cost of capital represents minimum rate of return that will result in at least maintaining the value of its equity shares. If the value is not increasing, at least it should be maintained. Means if We have taken the loan at 12% per annum rate of interest, and the amount is invested in the firm. What return we will get? If it is more than 12%, then taking the loan is advisable. If it is less than 12%, then it will be a wrong decision. The firm can pay maximum 12%, and this is firm's cost of capital because it is earning 12%. Cost of capital as a rate of return is calculated on the basis of actual cost of different components of capital, shares, debt, etc., etc. We will discuss after some time. And their weighted cost is known as cost of capital. It is usually related to long-term capital funds. In operational terms, cost of capital in terms of rate of return is used as a discount rate used to discount the future cash inflows so as to determine their present value and compare it with investment outlay. For example, the example which we have taken, that rupees 121 after 2 years at 10% rate of interest is equal to rupees 100. If the investment is less than 100, then this investment is profitable. And if the investment is more than rupees 100, then this investment will be a source of loss. Cost of capital has three components. Return at zero risk level. Normally, the investment in the government securities is taken as zero risk level. Premium for business risk. The business in which we are dealing, they have got certain risk. For example, if the subject matter of the business is an item which is easily perishable, then there are more business risks. For example, if you are dealing in the sweets after some time they will become useless. Therefore, business risk is more. Vice versa, if you are dealing with, in say, some cloth or iron, etc., the business risk will be less. You can't say that business risk will be zero, but it will be high or less. Premium for financial risk. We have just discussed that the future is uncertain. The investor wants something for this uncertainty. So really the cost of capital is return at zero risk level plus premium for business risk plus premium for financial risk. The cost of capital may be put in the following equation. K is the cost of capital. R0 is return at zero risk level. B is premium for business risk and F is premium for financial risk. So real cost of capital is the total of the three. Say if you invest the money in government securities and the rate of return is 12%, then nobody is going to invest in the business at 12% because he will require more than 12% for business risk as well as for the financial risk. Return at zero risk level. This refers to the expected rate of return when a project involves no risk, whether business or financial. As we have just discussed, for reference purpose, return on sovereign bonds, government securities is taken as risk-free rate. Purchasing power risk arises due to changes in purchasing power of money. Money rate risk means the risk of an increase in future interest rates. Liquidity risk means the ability of a supplier of funds to sell his shares, debentures, bonds quickly. Cost of capital can be classified as follows. First classification, explicit cost and implicit cost. Explicit cost is the discount rate that equate the present value of the expected incremental cash inflows with the present value of its incremental cash outflows. Thus, it is the rate of return of the cash flows of financing opportunity. In contrast, implicit cost is the rate of return associated with the best investment opportunity for the firm and its shareholders that will be foregone if the project presently under consideration by the firm were accepted. In a nutshell, explicit costs relate to raising of funds, while implicit costs relate to the usage of funds. Average cost and marginal cost. The average cost is the weighted average of the cost of each component of funds. All the sources have got their cost, and their weighted average is known as the average cost. Weight may be the amount which has been financed from every source. For example, if rupees 10 lakh is from the equity, rupees 20 lakhs is from the debentures, and rupees 70 lakhs is as the bank loan, then the respective weight will be 1 lakh, 10 lakhs, 20 lakhs, 70 lakhs, or 1:2:7. After ascertaining cost of each source of capital, appropriate weights are assigned to each component of capital. Marginal cost of capital is the weighted average cost of new funds raised by the firm. If, in the same example, our total investment is 10 lakh, 20 lakhs plus 70 lakhs, or rupees 1 crore, say a further 30 lakhs is obtained, then what is the cost of this rupees 30 lakh? This is the marginal cost. Future cost of capital. Future cost of capital refers to the expected cost to be incurred in raising new funds, while historical cost represents cost of capital incurred in the past in procuring funds for the firms. In financial decision making, future cost is more relevant. Specific cost and combined cost. The cost of individual components of capital are specific cost of capital. The combined cost of capital is the average cost of capital, as it is inclusive of cost of capital from all sources. In capital budgeting decisions, combined cost of capital is used for accepting or rejecting the investment proposal. Computation of cost of capital. There are four basic sources of long-term funds for a business firm. Computation of cost of capital of these individual sources helps in determining the overall cost of capital of firm. These four basic sources are long-term debt and debenture, preference share capital, equity share capital, and retained earnings. How it is calculated, this we will discuss in the next counseling session. That's all. Namaskar.